Hello friends, welcome to Make Money While You Sleep community and this channel. My name is Varun and today we are going to cover options basics. Couple of disclaimers. This content is purely for educational purpose and it is not intended for any investment or for financial advice. Alright, so let's start. Uh, so before getting into the options, let's try to understand what all asset classes we have for us in which we can trade or as well as can make money. So first is cash. It should be straightforward. We can have cash in our home or in the banks. Second is real estate. Again, very straightforward. Commodities. Commodities could be like something metals such as gold, silver, or it could also be a food item. Let's say wheat or rice. And people do trade in these commodities. And it's a huge market. The fourth is bonds or other fixed income investments. So governments or companies they issue bonds, which are pretty much in a way the loan works, in which they are giving some interest and ultimately after a period of time they're going to pay back. The next is stocks. Again, should be a straightforward. Uh, and if you need a help, just let me know, and I will be covering stocks in detail as well. The next is crypto. Crypto is a very new asset class, and you would have heard of Bitcoin and Ethereum and many other coins which are doing great nowadays. So this is also a very new asset class coming up. The last one is financial derivatives, and in that financial derivative class, we are only going to cover options. So what is financial derivative? Financial derivative is nothing but an asset or an asset class which has been derived from any other asset which we have discussed before that. So if we can make out a system or can derive a value out of any other asset, that is nothing but financial derivatives. And we'll try to understand from options how options have been derived from stocks. One of the important difference what I have observed is for derivatives is that derivatives have got a power of leverage. So the way leverage works is that your small amount of money can be leveraged for bigger trades or for bigger investments. That's how this leverage works. And we will look at it how it works in the real world for options. For in financial derivative market, it is possible that you put $1 and you are going to make $10. Just giving an example. Just because of this leverage. But at the same time, when you can make it, you can also lose a lot because of this leverage. So this is like a big make big or lose big. So let's jump on to the next one. So options basics. So options are nothing but a contract on 100 shares with a defined expiry date and a strike price. So you should definitely, whenever we are talking about options, you should always think about that one contract of option will contain 100 shares, and that will always help you understand the value of that particular contract. So if I take an example of Tesla, let's say, and Tesla is going for around $650 uh, per stock. So one option contract value which will be there in the contract will be 650 multiplied by $100. So the whole one option contract will cost you around $65,000. And this contract will have got an expiry date until when this is valid, and this will have a strike price. And we'll try to cover this as part of our example, and that will help you understand this better. So just like any other trade in any other asset class, there is a buyer and a seller of this particular contract, and that's how we any asset class will have its own marketplace and they can be traded. Make sense? The next one is this buyer buys an option and seller is going to give that option or sell this option, right? And buyer is going to pay a premium for this particular contract. So this is how it works. So pretty much if you want to understand it in a very simple manner, option actually work just like an insurance. In an insurance market, there is going to be a buyer of an insurance and there is going to be a seller of an insurance, and options work exactly like that. So let's take a car insurance example. You want to buy a car insurance and you are going to pay, let's say, a $500 premium per month for your $50,000 car. So similarly in options you will have $65,000 contract on Tesla shares for, let's say, for maybe $400 until that expiry date, and you will have a strike price too. I'll come to that. So ultimately, it, they work very almost similar way. If you understand insurance, how it works, you can easily understand options. So, and there are two type of options, call and put, and we'll try to cover them in detail one by one. So let's go to the next one, and hopefully it will be clearer to you. But for now, just have this thought that options work pretty much like insurance, and there is a seller and a buyer of that insurance contract. So what is call and what is put? So when somebody buys a call, when somebody is buying a contract called as call, and call is a kind of option, he had a mindset or an outlook that that stock is going to go up. So he's bullish about that particular stock. And we'll look at the example. How does that work? Uh, but and at the same time, if there is a buyer of a contract, there has to be a seller who is going to sell that contract. So there is a buyer of a call, and then there is a seller of a call. And if buyer of a call is bullish about a stock, a seller of a call, because he is giving that insurance to the buyer of a call, he has to become bearish about that contract. That makes sense. Just like insurance example, if a buyer of an insurance, he is not thinking about, if car will have an accident and all, because he has given that risk to the insurance company. But at the same time, insurance company does not want that the insurance buyer's car get into an accident, because then they will have to pay for it, right? So they work up against each other. One is bullish, then other is going to be bearish. If buyer is bullish, seller is going to be bearish. If buyer is bearish, then seller is going to be bullish. So let's look at the buyer of a put. So a buyer of a put is looking have an outlook that the price of a stock should go down, and it will go down in future. So he's betting on that particular aspect, and hence a seller of a put is actually bullish on that, and he's going to sell that contract. That, all right, you are expecting that the stock will go down. Why don't you take this bet from me? And if stock will actually go down, I'm going to pay you. Otherwise, this bet will not execute at all, or this contract of option will not execute. So let's move forward, and let's look at the call example. So I have taken this example for Tesla, um, and these examples are from my trading platform. I use Tastyworks. So let me try to deconstruct this one. So in this call example, a buyer is bullish on Tesla, and he is expecting that stock is going to go above $900 by March 19th. Make sense, guys? So what is he doing? Right now, let's say price of Tesla is around $650, and this guy is saying by March 19th, this is going to go above $900. I am very bullish. And right now we are in January. It's January 1st, by the way, guys. So happy New Year. Um, so he's going to place this contract. What will that say? Buy to open. So he's opening a contract where he's buying, and there is a call. C represents call over here. Buy, and expiry date is March 19th, which is 78 days away, and the strike price is 900. So he's buying this particular contract. And as I mentioned, buyer of a contract is going to pay for that as a premium. So he is paying $36.55 per share, which basically means multiply by 100, because every contract contains 100 shares. It basically means he is going to pay a premium of $36.55. Make sense? So if this is a buyer of a contract, there has to be a seller of the contract in the marketplace. Otherwise, this trade won't happen, right? So when this trade happened, there must be a seller who had who had executed a similar trade, and he has made the similar premium. So he has sold this contract, sold a call for 900 strike or for March 19. So minus one represents sell, and one represents one contract. And here it is plus one, which represents buy of one contract. So let's look at the example. So Tesla at $650 today, call option contract traded between buyer and seller for March 19th. So buyer buys a call with 900 strike for March 19th, and seller sells that call to the buyer. Hence there is a trade which is happening. So this I have explained. So, and there is a premium of 36.55 per share. For the sake of simplicity, let's just assume that it is $36 so that we can easily see the calculations. And so buyer is going to pay the premium and seller is going to collect the premium, just like the insurance company. So let's look at couple of scenarios which can happen in this case. So first scenario is if Tesla goes to $1,000 on March 19th. So Tesla goes above $900, which is a strike price for us, and it hits $1,000 on March 19th. And March 19th is a date when the consolidation of this particular contract will happen. And after that, there is no contract at all. Buyer and seller, they will dissolve this contract, and it is the done deal. And by the way, contract can also be closed earlier, not on March 19th only. It can also be closed earlier. And whatever will be the price of that contract on that particular day, that's how that the deal or the trade is going to happen. But let's look at on March 19th what can happen. So in this particular example, if Tesla will become $1,000 on March 19th, buyer will make $1,000 because that's the price of a stock on that particular day, minus 900, which is a strike price, minus $36, which is a premium of he has paid. So a buyer is going to make $64 per share. And given that every contract of option contains 100 shares, it is going to pay him $6,400. Make sense, guys? And because buyer is making $6,400, and in a market world, somebody's gain is somebody else's loss, right? So a seller is going to lose $6,400 in this particular trade. And in this example itself, or in this scenario itself, you can see the power of leverage. Buyer has actually invested $3,600, but he has made $6,400 over here, right? So he is making almost 90% over here, or 80%. He is making that much amount of money just by putting $3,600, right? So that's the power of leverage here. Now let's look at the other example where Tesla remains below 900 on March 19th. So guess what, guys? If Tesla remains below 900, so this bet is not going to execute, or this contract is not going to execute, because the buyer was bullish on Tesla and he was saying, okay, it will go above 900, but it did not happen. But Tesla is still below 900, right? So buyer is not going to make anything. He is going to lose this bet, and seller will keep the premium of $3,600. Make sense, guys? Exactly like an insurance company, right? Uh, Somebody is buying an insurance for 6 months from an insurance company. If some accident will happen of a car, then uh, insurance company will pay some money to the buyer, right? Otherwise, that insurance premium is going to go just to the insurance company. So this is a case here. So I hope this has been clear to you how call works in this options market. Let's look at the put example. So as I mentioned, put is nothing but the case where put buyer is bearish on a particular stock, and he or she is expecting the stock to go below a particular strike price by a particular date. So let's look at the example of Tesla again. In this particular case, a buyer is bearish on Tesla, and he or she is expecting that the stock will go below 300 by March 19th. So what he is going to do, he will buy a contract, and he will open a contract. He will put a strike price of 300. He will buy a put because he is bearish on Tesla. He is saying, okay, it is going to go below 300. He will open this contract for March 19th, and he will place this contract. At the same time, somebody is selling this particular contract to this buyer, and is selling this contract on the 300 strike price, this particular put, and minus represents selling, plus is representing buying, right? And buyer is giving a premium of $2.69 per share and $269 for 100 shares. and seller is getting that particular premium. So it is a credit over here, this is a debit over the buyer side. So remember, buyer is always going to pay premium, seller is always going to collect that premium. Just like an insurance company, this will happen. Buyer is giving their risk by paying that premium, seller is taking that risk by getting that premium. All right. So in this particular case, Tesla is at $650. Put option contract has been traded between buyer and seller. So buyer buys a put with $300 strike for March 19th, as we have seen in this contract, and seller is selling that call to the buyer. I'm sorry guys, this is put, not the call. This is a mistake over here. So this should be put over here. So I'll correct that later. So premium of $2.69 per share is what we are seeing in this particular trade. Hence buyer is going to pay that premium, and for the sake of simplicity, let's just keep $3 per share rather than 2.69, and seller is collecting the premium of $300. So what's going to happen on March 19th? Scenario 1 is if Tesla goes to $250 on March 19th. So Tesla crashes. Right now Tesla is at $650, but on March 19th Tesla will go to $250. So buyer will make $300 minus $250 minus $3, which is a premium, hence $47 per share. So 300 is the strike price, 250 is the current price, and $3 is the premium which buyer has paid, and he will make $47 per share. Hence $4,700 on a total contract which has got 100 shares. And just like any other trade, somebody's loss is somebody's gain, somebody's gain is someone else's loss. A seller is going to lose here with for $4,700. So let's look at the another scenario. If Tesla remains above 300 on March 19th, again the way we were seeing call, the similar scenario will happen. This bet will not execute because buyer who was bearish on this particular stock, and he was expecting it will go below 300, that never happened. So if it did not happen, this contract won't execute at all. So buyer is not going to make anything. He is going to in fact lose $300 premium which he has paid, and seller is going to keep that premium. So this is how option works for put and call. Once you understand this particular way, the way it works, I think everything else is going to be a breeze for you guys. And I hope this example is making sense to you. And once you absorb this example and you understand this example very well, all other strategies will come very easy. And I hope even the way I have tried to deconstruct these trades to you, right, you are able to understand that whenever you see a taker for any option, right, you can easily understand what is that particular person is doing. All right, so a couple of takeaways. Options, for the sake of simplicity, just work like an insurance. Whenever somebody is buying or selling an option, you can easily think in the way of insurance, that this guy is trying to sell an insurance or buying an insurance, right? And at least for the scope of this basic session, we should always look at it in this way. And just like an insurance, right, more the risk in a stock, there is a more is a premium, and it works exactly the way insurance works. If there is a more risk for, let's say if you are buying a car insurance and you are living in a zip code which is in a higher risk area, or there is more thefts or more accidents happening in that area, the insurance seller is going to increase your premium, because they have already done all that calculation, and they are going to increase that premium because they are taking more risk for that person or for that area. So hence, more a risk in a stock, you are going to get more premium, and less is a risk in a stock, or stock is very stable, there will be less premium. And I might cover that further, but you would have already observed that there are a lot of options in the options, right? So hence it is called as options, because you can short market, you can long market, you can also be neutral about the market, you can be very directional over the market along with the leverage, or you cannot be directional at all. We will cover all those different options and the strategies one by one, but options have got a lot of options, and that's why it is very interesting field. So one can make money in any direction in options, as I mentioned, or without being directional in options. So hope this is helpful for you guys to understand the basics of options. We'll keep covering option basics further, but once you absorb this particular learning or the session, I think everything else will be very easy for you guys. So yeah, this is that is a guide. So we also have a premium membership for our community. I would encourage you to join our premium membership. This is going to bring enough commitment from your side to learn options as well as other ideas and other strategies, not just options. And it will also help us invest in the website, content, and the community growth. You can leave membership anytime. If you are interested, you can register on moneywhileyousleep.co. And I also share my real-time trade alerts with my premium members, by which you can learn, also earn at the same time. And if you like those trades, you are always free to execute them. But you have to ensure that you have already understood the trade, how it is making sense, and then you're executing it. So yeah, that's it, guys. So relax and enjoy. Let our money work hard for us instead of we working hard. So that's the whole idea of this community and money while you sleep. If you have any feedback and questions, feel free to comment and let me know. And do share and subscribe. Thanks a lot. You have a great day.